Hello, everyone. Welcome to the new market talk. So Vi will not be joining us today. He's got some personal stuff to deal with, but he will be on in 2 weeks. Today we're going to start with Matt. So Matt, what's going on? What do you see in the market? What did you do these past 2 weeks?
Hey, everyone. Nice to be back after 2 weeks. I have not done much in 2 weeks. I've been set up with some pretty big short positions, adding to those as any rally comes through. I've been sitting on puts in IWM and SQQQ calls, as well as VIX calls that are going out to June and September. And those have been my best performers by far. My portfolio, I am still short the 10-year through the inverse product, the ETF, which let me pull these up. I have my fixed income positions in short junk bonds, TTT, which is the Ultra Pro short treasuries, and then PFIX I'm long, which is the interest rate hedge. In the FX area, I am still holding on to UUP, EUO, which is the short Euro Pro Shares ETF, as well as short gold, which the two positions that have been hammering me, but also offering somewhat of a hedge when things flip, is the short gold and the short treasuries, obviously with the latest rip with the rates getting ripped to the downside. I have actually added to the short gold and my treasury shorts today. In addition, I added to PFIX. I released a lot of hedges about a week and a half ago. I got stopped out of some longs that I had, not tight stops, but I got stopped out of a couple of oil longs that were equities that I also got stopped out of UCO, which is crude long, because it fell out of the range that I was trading and I had to stop under the range. I might start nibbling back on that because it's reaching some pretty extreme levels to the downside. And I can't imagine OPEC's going to allow that to happen without having some sort of a meeting to curb the bleeding on that end. By all means, it's the last few days of trading have been absolutely insane from a Z-score perspective in rates and also in FX. Things are just getting haywire out there, and so I expect that to calm. I think that eventually we're going to continue to see inflation return, even though today's PPI didn't show that. I think it's going to come back because, as we saw with CPI, they can't stop it right now. And if Jerome Powell next week comes in at 25 basis points or less, I think the markets might rip on the news. And then the realization will come back that he's dropping the ball on inflation. In other words, he's performing a pivot, which is going to cause inflation to go higher. And so that's my basic theory on what's coming. I'll probably reduce my shorts in the next couple of days pretty hard, because as Bryan and Raph know, our mom in our Twitter group share has instructed us that we should probably reduce our shorts. And I trust her evaluation. I value her opinion on that because she's pretty connected to what's happening in the markets. And so that's basically it for me. Been a good couple of weeks for me. I can actually go out to happy hour and afford it, which has been nice. Other than that, that's it for me.
Thank you, Matt. Yeah, a lot of interesting stuff. Now we're going to go to Andrea.
Hey guys, hello. Well, thanks for having me again. Pleasure to be back. Okay, for me, the past couple of trading days have been quite rough. I remember coming to the show and say, guys, be ready to short bunds, but I shared pretty much on Twitter also how I posted how the moves were quite overextended. Inflation swaps were trading like since the beginning of the year at 3 sigma, incredible movements. And I started to say, okay, it's time to be a little bit more constructive. But the move was crazy. I have to say that the movement, especially of today, on the Credit Suisse news or whatever, started to really hurt me because I started to short again. I added to the position and I started to short also some shots, which is pretty much the 2 years in Germany. You can think about it as a proxy for ECB policy. It's interesting to see also how different the spreads in Europe are kind of reacting. We are seeing some stress emerging. BTP bonds is widening, but still, I think there is room to short fixed income in Europe. Regarding other stuff, I was playing the Euro stocks on the short side. That one really paid off. And also I was trying to short the GGBs in Japan, which is one of my favorite trades, with the best GGB trader in the world, namely the head of the central bank going retiring and enjoy his trading desk at home. But still, what I would like to show just to be, this time I came prepared. I think that we need to kind of understand what happened in the past few days in terms of technical moves and fundamental moves, because we need to distinguish the two. So I will try to share the screen. This one should be okay. Okay. What I'm showing you is pretty much the okay. My work is spend quite a lot of time to analyze how those trend followers behave and how they build their signals. So their signals are most of the time based on two factors. The first one is the momentum factor, which is usually the numerator, and at the denominator they have a volatility estimate. So they try pretty much to come up with a sort of ratio or a standardized signal where they tell you, okay, you should have this position with these assets, and they tend then to do a sort of average with 4 different look-back windows. And the interesting part, if you look for instance in the fixed income, namely like you can use the 2 years, 10 years, and the shots, you can see how pretty much everything's. So these can tell you a couple of things. The first one is that in terms of ratio, the ratios went down quite a lot. I track them pretty much on a 1 month basis and a 3 months basis. Here you can see, wait, I'm doing something wrong, like this, okay. Here you can pretty much see the implied positioning, meaning usually when these kind of trend followers, they go into the market, they look at the 1 month, 3 months, and 12 months. Usually the 1 month is the one that really dictates the reversal in the move. And I want to show you, like, just look at how the signals change in the 2 years and in like the 10 year, in whatever fixed income market you see. This triggers a lot of short covering, and you see a lot of moves in the fixed income market, as we saw in the past couple of days. This of course has implications, meaning that then of course, since equity and bonds, they try to trade these days in the same manner, they tend to help, especially Nasdaq, that is more rate sensitive. But it's quite interesting to see these kind of moves and to distinguish between what are the fundamental reasons and then the technical reasons. Because as soon as these technical factors, they are dropped, then we go back to trading the macro and not the flows. And well, it starts to matter again. And just to show something that last time I didn't show, but I found out that I can show it. Pretty much I build different indicators. So if someone wants to check, just check the paper of AQR, I think it's called Momentum, or if you go through their research, you can find it. What is interesting is to see that in terms of inflation, they're still trading pretty much at the 2 sigma level. And this is an indicator that looks at the trend and looks also at the inflation price compared to what consumers were expecting 1 year ago. So it pretty much tells you that inflation is not a done deal. Of course, we are coming down quite a lot. The PPI of today confirms it. But if you, for instance, the IS services from S&P Global, firms are passing all costs to the consumer. So this is for pretty much for companies because they are able to widen the amounts. But of course, it has a cost for the consumer. And I think that as soon as we move into more Q2, I tend to think more Q3, we will start to trade a little bit of disinflation. And then we be an interesting spot to buy bonds. But still, and then I'm done. I want to, I calculated some measures from Bloomberg just to tell you. I was looking at the super core, which pretty much is like a super narrow measure to see services. And what strikes me is the month's momentum that you have. Since Powell cited disinflation in press, there has no been deflation in the super core for services. Instead is quite the opposite. So I tend to think that they are not done. I think they will continue to hike despite the market doesn't think so, because we have this banking problem. But that can be really painful. And especially if they don't act, this problem can be even more exacerbated. And well, that's pretty much what I have. I just do just one thing for someone who wants to trade, maybe inflation expectations, break-evens, and so on. In days where you have dislocations, like in the past days, and you believe inflation is here to stay, that's a cool place to look for something. You can trade like the STIP against the IEA, which can be an interesting trade.
Thank you, Andrea. Certainly agree with inflation not going away, and the Fed potentially about to make a huge mistake if they don't keep hiking.
I tend to think so, especially because at the end, okay, in terms of leading indicators, we still have some sort of strong economic growth. I have an indicator for economic growth, which pretty much is in neutral trend, but still, it's in the system. I mean, it cannot go away that easily as everyone thinks, and it's the same in Europe. In Germany, they are giving raises to everyone, so it's pretty interesting.
Yes, indeed. So now we're gonna go to Ted. Ted, so what do you see? What did you see, etc.? What did you trade these past 2 weeks?
Yeah, so I have a screen to share as well here. So I see it a lot like you guys do, I think. But let's see. So let me just work this out here. All right. So when I was on last time, March 1st, 2 weeks ago, what I was sharing at that time is that I thought the risk of a crash was rising pretty rapidly. Saw a lot of early changes in vol indicators that caused me to largely head to the sidelines. Added to dollars on pullbacks, added to shorts on bounces, added to VIX-M at the time. And as you'll see at the end of this presentation, I sit about 75% in bills right now. And I'm, for reference, largely a trend following type of trader. I do trade volatility bands, but this kind of volatility definitely raises havoc with any kind of trend following system that you have in place. So on Sunday, I communicated that I thought not only were we beyond crash risk, we had released the Kraken here, and this guy, Thiel, basically single-handedly caused a run on the banks through a Slack message. And as a result, all these guys that were holding capital that were, basically their capital for sale were forced to sell and mark to market. And in a matter of 48 hours, we had two significant banks fail, SVB, and then obviously Signature Bank in New York, kind of as an aside over the weekend. But same reason. And part of me thinks that there's some sort of Wall Street bets thing going on here. So we have to take a close look at whoever the short sales were and SVB rather. But basically on that news, all hell broke loose last week. We've seen cross-asset vol move dramatically, particularly Treasury volatility. 169.65. It actually closed unchanged today. These are yesterday's charts. I wasn't able to update them today. But we're talking about volatility that exceeded the volatility that we had back in May of 20. I'm sorry, in March of 20, when the bond market was falling apart. 3.4 standard deviation move and 2-year treasuries in 2 days. I mean, that's insane. If you can trade that, you're much better than me. Same thing we saw yesterday. 2 days ago, volatility started to rise pretty significantly in OVX, oil indicator. I've been pretty much looking at a trading range for crude oil, WTIC. We've talked about that in the last couple of times, from 82 to 72. Well, that got taken out yesterday. And then, of course, today we traded down to as low as 64, 65, I think. So, we've got stuff breaking kind of across the board. We've got gold volatility just ripping. In my all-weather account, I've been selling gold on this move. I mean, upside volatility, I've learned pretty quickly, is not necessarily a great indicator for the asset. So gold actually was up today. But had a big breakout above its one of its volatility bands, and so basically stuff continues to move. I don't have a good indicator for U.S. dollar volatility, but I use Bitcoin as a proxy, and obviously that hit the top of the range. It basically went from the bottom to the top of the range in 3 or 4 days on this move down in. Or availability of liquidity, and perhaps a perceived dollar failure. You saw the dollar close down yesterday. It is actually up 1.25% today on that move. So dollars kind of holding pace here. So here's, you guys have alluded to this, but this started last week. We had on March 8th, Powell was basically recommitting to the job of bringing inflation back to our 2% goal. Restoring price stability is key to that. And the historical record cautions strongly against prematurely loosening policy. And then we will stay the course until the job is done. Well, good luck to that. So basically, he's got a couple of things to look at. This data came out Friday. Nobody looked at it because we had bank runs going on. It didn't make a lot of headlines, but we had average hourly earnings tick up in the United States to 4.6% year over year from 4.4%. We had core CPI today. Core CPI out last week. Up to 0.5% on a month-over-month basis. We had PPI today come out actually down 4.6 to 4.6% from 6%. So a little bit of cross currents there. Retail sales, some are characterizing this as strong. I don't see it. 5.4% year over year after inflation's negative. But apparently some are calling this strength in retail sales. I guess because they're looking at a 3-month rolling basis, and you've got that 7.7% that came in January, and that's skewing some of the figures, but I'm not seeing the strength in the retail sales that people are talking about. So that puts Powell basically caught between a rock and a hard spot from my perspective. This is out from 2 days ago. This is the meeting probabilities, CME FedWatch tool implied probabilities. And what we were looking at 2 days ago was implied probability of a 25 basis point rise in short rates to at 82%, and another increase in May. And then we start backing off and backing off and backing off as we make our way through the calendar. This last week looked much different, as Bryan pointed out earlier. And today, even probably it has shifted even further to no rate cut. So let's see. So from my perspective, the setup coming into this week into early next week, we've got banks wobbly. Credit Suisse today, Swiss Bank came out, Bank of Switzerland came out today and said they're going to prop them up, and that was an immediate boost to the stock, which was down well over 20%. But we got U.S. banks wobbly. That problem has not gone away. We still have, quote, pristine collateral under pressure. We've got financial conditions that have eased considerably with the 2-year down in the 3.7, 3.8, 3.9 range. Who knows? I can't keep track of it. It's moving so fast. We've got potentially positive flows into an epic OPEX on Friday. So, basically this is going to be a record options expiration. And so what I've observed on these quarterly, it's actually a monthly, but it's into a quarterly month. What I've observed in those months is whatever happens on Friday tends to follow through on Monday and then reverses. So my intention is to fade whatever the Monday close is. We've got next week VIX expiration on Wednesday, the VIX option expiring, and FOMC on Wednesday. I think that leaving aside the 25 basis point increase or decrease or whatever they decide to do, it's really the summary of economic projections or the dot plot that's key. I think last week we saw Powell start to manage that up to about a 6% terminal rate. We'll see where they go based on that, on the occurrences of what has only happened over 1 week period of time. I think if we get a pause, then we're clearly going to be into a stagflationary environment. I want to be long CRB. I want to be long gold. I want to be short TLT and the dollar if we go into that space. If we go up 25 basis points or more, and again, maybe even look at what happens with the dot plots, I think we're looking at a disinflationary setup. I mean, it's pretty binary from my perspective. I'd want to be short SPX. I would want to be long TLT, and I'd want to be long the dollar. Although, given the volatility, I'm hesitant to allocate a ton of money to anything at this point in time. So just from a, where am I positioned? I show, this is my trading account. And my trading account, I show what I had on 3/1, which is the last time I was on. And where I am now, you can see my bills position has gone up. My cash is basically allocated cash to that position. UUP, I sold some. We had a pop about a week and a half ago, I think. Pop on, maybe it was Wednesday last week. I sold some of that, and I sold some of my CTA, which was lucky timing because it has subsequently gotten trashed in this market. This market kraken, as I'm calling it, just a lot of volatility that's chopping it up, and I don't think trend systems are able to move as quickly. If you look at CTA, it went straight up with the dollar, magnified by probably 3 times, and then it went down hard with the dollar over the last several days. Still have a DXJ position. Still have a EWW position, Mexico, which I'm just about ready to get rid of, I think. Next CTA, as I said, I still have TLT, which is fully hedged or almost fully hedged with TBT. TLT in my book is still neutral trend, so I'm not committed to basically taking off that hedge at this point in time. I've increased my exposure to VIXM. That's been working really well. I've kept my position consistent with SH and actually increased my PSQ, which is short Q's position, to 3% today. It's at 2% now. I did have a 2% position in DBA that I've taken down to 1% over the last 48 hours. I'm out of China altogether. I took my gold puts off a couple of weeks ago and prematurely took off my EWG short, which worked for me, but not at the same level that I'd hoped it would work. And of course, I took it off too early because we got that pay today. So that's where I am.
Thank you, Ted. It's very educational, a lot of information in there. Next, we're gonna go to a newcomer. So it's Robbie. So Robbie, can you maybe introduce yourself very quickly, because it's the first time you are coming in, and then you can share what you see in the market, what you have done these past few weeks, and maybe what you see in the future.
Sure. So my name is Robson Chow. You might know me from Twitter. My handle is HalfersPower, and I have a trading analytics website called tradewell.app, which I've been working on for the past couple of years. So I do most of my analysis through that platform. What I've really been looking at the past couple of weeks is the vol spot beta, I guess you could say. So how implied volatility is reacting to moves in the S&P 500. And one good way to show that, I think, is if you just take the realized volatility of one of the volatility ETNs, and I will try to share my screen. So this is just the decaying VXX ETN. But you can see basically the realized volatility of VXX is almost 80% over the trailing. Can you guys still hear me?
Yes.
Yes,
Yeah,
we can hear you.
Oh, okay. It said Zoom quit.
I might be disconnected now.
77.3% annualized over the trailing month.
We lost your screen share, Rob.
Oh. Okay. Can you see it?
Yes.
Yes.
Yeah, and the big difference is that is way higher than the period in 2022. Interestingly, and what's really interesting though is the spot move has been just kind of very minimal. So that's the main thing I'm focusing on. Basically, it just tells me.
Yeah, Rob, we lost you again. Okay. Maybe we move to Bryan until Rob is back.
Sure. Yeah, I can go, and then whenever he gets back, we can.
He's connecting again. Wait.
I'll give him a chance.
Yeah, Rob, are you here?
Yeah, I apologize for that. My Zoom crashed for some reason.
Okay.
But yeah, it's a different volatility environment than 2022, which is very clear. Past couple of days, I was kind of looking for something more than we got. there's 3 days in a row now where we tried to poke above, I guess, the 30 level and we couldn't. And so that makes me question whether we're going to get a continuation in the near term. But I think there'll be lots more opportunities in 2023 to re-enter if you're looking to get long volatility.
Yeah, so for now, yeah, I'm basically looking at the same thing. Yeah, we've been unable to break the ceiling of VIX 30, right? Every time we take a like just to try, short sellers step in.
Right, right.
So, I mean, what do you think are the chances that in the next few days we could actually break this ceiling?
So the other thing that I was looking for in the past couple of days, I like to track implied and realized spreads in volatility. So 2 days ago, we had the spread between close to close and VIX, I guess, close at about 11 points. And usually from that level, you get a bounce, but it's not necessarily a bullish bounce because what happens is two things. The spread compresses, so you normalize the spread a little bit and you get a correlation spike. So that correlation, that short-term correlation spike between sectors happened yesterday on the bounce. Today, I was really surprised that tech continued to hold in there. So I haven't got the correlation data yet for today, but I would not be surprised if correlation actually came down. On future bounces, I would continue to look for increase in correlation and a narrowing of the implied realized spread as bearish rather than bullish. If the opposite happens, whereas correlation continues to come down and the implied realized spread normalizes, then I would take bounces as less bearish.
Makes sense. Makes a lot of sense. And what's your view for, I mean, do you have a view, for example, on what happened with bonds recently and the spike in volatility for this asset?
No, my focus is not really on bonds, but again, the implied volatility stuff. We got the first hint that something was changing from 2022 in February when the vol spot beta changed. And so I think what we can expect is more of this kind of insane vol futures moves. It does not look like it's going to be like 2022 again by any means. Just the odd part is that the S&P 500 isn't really all that volatile at all. I think if you look at the intraday measurement of historical realized volatility, you're at about 21% right now. We got much higher in 2022, but the volatility reaction was much different.
So basically, VIX is more volatile, but SPX is not volatile as it should be.
Well, yeah, I guess it hasn't gotten that volatile yet, but there's an obvious demand for hedges that was just not there last year.
Yeah, I think Bryan will agree with that. So we should expect more volatility in the coming weeks and months. For example, when you say the volatility structure is different from last year, would you expect, for example, less bear market rallies and more very narrow chop action until something definitely breaks?
I'm not exactly sure what I forecast for price action per se, but I would not expect the realized volatility to stay as low as it has been in 2022. And 21% realized volatility, given everything that's going on, seems ridiculous to me. But the main thing is that we've got sectors like tech just not really they're not reacting to the bad news because they're taking, I guess, the rates moves as good for the tech companies, which I don't know. It just seems like the news is so bad that it doesn't make a lot of sense. So in that sense, I think realized volatility in the indices should continue to pick up, because I'm not convinced that tech will maintain that positive stance towards a cut in rates.
Yeah, it's and I agree 100% with what you just said. Do you want to add something?
No, that's great. Thank you so much, Raph.
Thank you for coming in, and you will be back also in 2 weeks with Vi also coming back.
Okay, perfect.
You can. I mean, I know you guys know each other, and yeah, I guess it will be very interesting to see you two talking about that. So now let's go to Bryan.
Hi. So yeah, so the last 2 weeks have been just crazy. I mean, I've been doing this now full time for 2 years on the button, and I've never seen, like, the last 2 weeks have been the most dynamic I've ever seen so far. So it's really interesting. I'm gonna share my screen here. We're gonna kind of walk through it all. And a lot's changed. So there's gonna be some stuff that I missed for sure, and we'll just have to take with it. It's pretty uncertain for me from here. I don't know really what direction it's gonna go. I'm just kind of playing it as I get the data in and see kind of how it turns and whatnot. I'm running a lot less positions, but I'm still keeping the same kind of size. So my positions are a lot larger, but I'm running less in order to just kind of go with higher conviction plays. And then if it's not looking good, just dump things. So I'm being a lot more nimble here, but I still want to have big size on to capture days like this. Cause I mean, the moves that we had right here, I mean, that's some of the most money I've made trading ever. So it's been pretty awesome. So just recapping here, looking at the Russell 2000 as, you know, the one that got hit the worst, and I guess the one that really just won it for everybody. So February 2nd, some people might disagree, but that remains bear market capitulation day. It's confirmed. I don't care about the move in yields that we've had recently. All the bears capitulated on February 2nd. So since that date, my entire bias for why I was so aggressively short and why I thought that was capitulation day was the idea of the data starting to come in more hawkish. We were pricing in cuts back then for 2023, and all the cuts as soon as June in 2023 and then into 2024. So both the bond market and the stock market at that time were completely off sides, and dollar I thought would bottom, bond yields would bottom, gold would top, all of that. So got really short into that. That was absolutely awesome. And that just played out to a T throughout the month of February. So if we're looking here, now I don't have as great macro data things as Andrea, but just very simple in terms of just tracking the data. This isn't doing some kind of algorithm. It's just tracking how the data came in. Looking at the January prints that we got in February, we got a lot of hawkish data, and it just kept coming and kept coming, and it didn't stop for us. The PMIs came in hot. The prices paid components came in hot. NFP came in hot for us. Ted mentioned it. Our average hourly earnings, those were coming in hot. CPI went absolutely nowhere. In fact, median CPIs ticked up over the last 3 months progressively. Core is flat. They revised up the December print from CPI to become more hawkish for us. So the data was completely on our side. So both the bond short and then subsequently rate sensitive equity shorts were completely backed up by the data that we had. And it was all going towards the point of the big flip. Now, people have heard the big flip. I was subscribed to the big flip on February 2nd, and we got the big flip. Last week, 1 week ago today on Wednesday, they priced in 81% probability that the Fed was going to hike 50 basis points at this meeting. And that was the entire reason I was short. Like, I wasn't setting up for some big blow up in the banks that now everyone says that they called, of course. I was short strictly because of Fed hawkishness. Now staying short into that 81% probability that they were going to hike 50 at this meeting next week. And because things were still working in the favor, and I was managing the short from there. So we got the big flip. The big flip happened, but then the big flip just got smacked in the face and completely flipped the other direction, even more aggressive rate that we saw on February 2nd. So now we're at the point, as of the close today, it was a little higher intraday, but now pretty much they are entertaining the fact that the Fed doesn't hike at all next week. And to make it even worse, they're now entertaining the fact with a 23% probability that the Fed doesn't even hike at all in May. And so I don't know if this banking thing is really that big of a deal to Jerome and whatnot, if it's going to cause them to do that. I really have no idea. But all I know is that the move that we've now have seen in bond yields, if we just look at like the 10-year, actually let's go to the 5-year, I like the 5-year. It's all a function of that. So here we look here Wednesday, the date I just told you 1 week ago, 81% probability that they were going to hike 50 basis points next week. And now we're pricing the fact that they're not going to hike. That is all that's happened. And the flip side of then the action that we received over the past week through that move, and March 8th, that's when I went kind of balls to the wall. And it wasn't because of bank things, just because stock bond correlation started going positive into that move. And I thought the volatility would come from that, and it did. That we've started trading deflationary risk off. Okay, and so that's now seen through stock bond correlations being deeply negative. So you look right here, this is all SPY correlations. The chart right here got 3 duration bond ETFs as well as European bonds, and then dollar, which started improving today. They're trading firmly negative. And so that's seen under the guise of, you see it today, TLT was up big on the open, stocks gap down on the open. Intraday, TLT, they're trading opposite right now. I don't think it lasts. I think this is temporary as far as the banking noise continues on. There's volatility around that. That's what's driving stock bond correlations being negative right now. Other than the banks, there has been no data at all to confirm that we're in recession. Labor is fine. Inflation is still sticky high. None of the PMIs have started cracking again. We got the housing market data, NAHB today, and that's a very coincident indicator that showed another tick up now for 3 months in a row in the housing market. Now we see these bounces typically before then the recession, then it comes back down. But we're seeing a tick up in housing. So it's like everything besides the banking issue is still what we had back on February 2nd. And the main reason I was short, and now the reason I'm evaluating how short I should get, more, less, we'll see. But like that's still the macro perspective. We're still in a very hawkish environment where all of the economic data is continuing to put pressure on the Fed to continue hiking. And so under that guise, I look at this stock bond correlation, and I understand, like typically we've seen stock bond correlations be negative towards bottoms where both bonds have been down as well as stocks have been down. And then for May is a perfect example. And then that was supportive to the fact that those correlations would revert back to positive in a way that yields come down and stock would go up. And then into the up move, the correlation would begin to re-strengthen until it got to an extreme again. And then that's when you'd re-short, and that could help you time tops. And this has worked very well. And into March 8th, correlations were very strong into that move. And then since then, for a week, they've now progressively weakened to the point where you see here 5-day correlation, very short term, firmly negative. They've been trading opposite. And so I look at that, and it doesn't have me pressing shorts right now because I want to see that correlation start going back toward positive. But I can't help but think right now the way that the NASDAQ has just held up. If we look at the Qs, this is what Robbie was talking about. I mean, they've gone nowhere. They've completely diverged from the Russell 2000 in this deflationary risk-off environment. And it's the point now where they've bought both. The consensus is covered all their bond positions, all the long only RIAs. My parents have one. I saw their note the other day. They're all getting long bonds, and they're using this excuse with the banks as a reason to add to their losing position they've had for a year and a half. And so they're all getting longer bonds here, and they think that's a good idea to buy tech too. And so the reason that NASDAQ has not puked with the Russell in this move has been because, and now it's outperforming the bounce, has been because of this move in rates, at how they've been supported here. If we look at like the correlate, the spread between Russell and Qs, IWM and QQQ, we look at MFR. I don't have it loaded up, but it's at the bottom of the long-term range in MFR here. Scott, you put a buy signal on your signal, Raphael, on that one. And so I think we're at the point here where the narrative, whatever you want to call it, starts to shift. The banking stuff's going to cool off, and we're going to then shift back to what's been happening with the macro, where Fed is going to stay hawkish. The data hasn't confirmed any kind of pivot. And now the current pricing in Fed fund futures is absolutely insane to even consider the fact that they're not going to hike at all for the next 2 meetings. And I'm not sure about this next meeting. You know, maybe they need to get Nick Timmeros out there to go put out an article about how they're going to hike 25 at the next meeting to fix this. But the pricing in the bond market right now is equally similar to what it was on February 2nd capitulation day, besides this guy's over of the bank stuff. And so it's a very interesting situation, and it's very uncertain because, you know, we've had this vol spike, which we didn't have on February 2nd, where equities have gone pounded and puts are a lot more expensive now. And it's causing obviously more volatility, and hopefully it causes more realized volatility. It's crazy how high we've gotten VIX and how we haven't even gotten a down 2% day on the S&P through this move. So it's wild, but it's just we've got this vol spike now. Bond markets and on the flip side, bonds have absolutely ripped back to their highs. They've all transitioned back to bullish trend on the bonds themselves in MFR. So whether that continues higher, I'm not sure. But, you know, I think in order for stocks to have a sustainable bounce here, we need to have bonds continuing higher. And the only way that could happen would be we have both the banking issue calms down completely and the Fed actually goes full dovish. If that happens, you're going to get a vol crush plus bond yields going down. And in a scenario then where the Russell would probably outperform and close this spread because all the banks would probably bid very hard. Like if you're trying to buy the dip in that, trying to buy some regional banks is actually probably a good idea. But on the flip side, you look at the spread, and then with the way I'm thinking, you know, keeping to a bearish bias because of everything that's going on, and also the pricing in the Fed funds futures, is I think NASDAQ has to underperform Russell here into a down move potentially. And so that would come under the guise that they somehow fix what happened in the Fed funds. Jerome Powell comes out next week and doesn't even mention SIVB and all the banking issues. And they just talk about how hawkish the data's been and that nothing's changed. Then they hike. I guess they'll be forced into hiking 25 unless something happens where they can hike 50. I don't think they hike 50. I don't know. I really don't know. Like I said, I don't know what he's going to do, but those are the two outcomes I see. I see a bounce that comes with both Jerome and Christine and all the lot just going full dove and making another mistake after they mistakenly hiked 25 basis points at the last meeting, which marked the top before February 2nd capitulation day. And all the data came out hawkish after that. So that was clearly a mistake. And so now they're going to shift down again after they know they made a mistake at the last meeting and hike 0 with more hawkish data to come, so that they hike 0 and all the banking stuff calms down, we get a BMR. But I think on the other side is the banking stuff could calm down or stay kind of shaky, and Fed could come out and still be very hawkish. And then you'll get NASDAQ give up the ghost. I mean, you look at NVIDIA, they're buying this thing every single day. Since it has a little pop on the earnings report, buying it. They're still buying the bloody dip in this thing, even after all the real bears capitulated on February 2nd. So things I'm looking for at this point, if we look at the gamma structure, and I'm going on long here, but there's just so much going on. If you look at the gamma structure on SPY, 390 is the big level. We've continued to hold below it, even with the squeeze today, the squeeze yesterday into the close, low put squeezes. We're continuing to hold below 390. That's absolute gamma. 400 is gamma flip. We need to definitely hold below that. Otherwise, you know, I don't know, we have a more significant BMR, but if we keep holding below 390 here, that's my trigger to be remaining short and continuing to look short. I would be looking for stock bond correlations to re-strengthen into an equity down move. If stock bond correlations re-strengthen into an equity down move, I will be pressing more shorts. I also want to see the dollar continuing to do what it did today. Dollar had a great day. What a beauty. I mean, euro just got pounded so hard. Dollar had a great day. And so this one hasn't confirmed what we've seen out of bond yields, which is really interesting. Dollar actually now has recaptured about half of its loss through that 3-day puke in bond yields. And so the dollar isn't confirming what's happening in bonds. And today it traded awesomely as a risk off vehicle. So I like the dollar. I look for that correlation to restraint and look for stock bond correlations to go back to positive. And then sector correlations did soften today, like Robbie said. And that was because you saw a bid for defensives, XLU, IWM, great day. What an amazing thing. You know, still long that spread, still long XLU, IWM. Another spread that I'm not long it, but I look for it as for signal, which also peaked on February 2nd, bear market capitulation day, is the high beta, low beta ratio. This one's trying to break down here. If this one keeps going, I like what I saw today. If that one keeps going, that's another reason for me to stay short here below 390. And if high beta keeps underperforming, tech starts breaking, stock bond correlations go positive, I wouldn't be looking for an equity bounce. And then, you know, so that's then under the guise of VIX has now spiked so aggressively. And like things like you're looking at the vol products, Robbie, like VIX-M, I mean, that thing's absolutely ripped. I've never seen it go up so hard. I'm long that one. And then PFIX, that thing, it doesn't matter if TLT is green, yellow, red, purple, it doesn't matter. It just goes up too. So like vol is getting bid very well. So I don't know what that means. I don't know, maybe this banking issue is a bigger issue. And then does that mean we keep trading deflationary risk off? So it's like you have the banking issue, which is blown out credit spreads. We look at LQDH, for example, that's investment grade credit spreads, HYGH, that one got absolutely wrecked today again. Credit spreads have gotten absolutely pounded. And so that's pressuring credit spreads. And at the same time, you know, the Fed, which I think should be, maybe they will, more hawkish. And so that would spike bond yields again. And then that's how you get the real crash out of this. Whether that happens, I really don't know. But that's what I'm looking for. And I want to keep size on for that because that would be a vol event and a half. So we'll see. That's where I'm at.
Thank you, Brian. A lot of data. So yeah, my turn now. Up. Yes. Up. Let's go. So I'm gonna do what I usually do, go through the volatility profile of everything. So like I mentioned in the previous show, I was looking for a retest of 4080 to add back. So we basically had it, retest, then the crash started to happen. Volatility is looking great. This is US 500. I'm watching it because I prefer to look at the volatility profile of US 500 rather than SPX. So we got the first move in vol, then retest of trade, and then the spike. Okay, so that's where we are now. So volatility is rising. We are breaking trend. Especially you can check on MFR. It's the same trend. Are breaking everywhere on equities except in tech. But you guys have mentioned it. It could be because of the inverse correlation to yields. So that could be the reason why it's not going down, but I would expect this thing to go down later on. So for now, I'm still holding shorts. I'm thinking we will go lower. I'm actually looking at the hourly to see where I can add with size. So setup I'm looking for is basically to see trade on hourly, so trade of vola on hourly to get slammed down. So the level I'm watching is this one, 0.5. Anytime I see the trade goes there, I just go crazy short. And what happens, I've addressed this thing many times before, you get a vol spike. And when you have vol spike, you have price going down. So this is what we had around 40.80, 40.50, 40.80. Now we are back down. I'm looking for this setup to reset. So I want to see trade to go down and then have this kind of setup. But yeah, for now, volatility is trading higher. I'm not getting any buy signal, so no dip for me. That's where we are in US 500. Nasdaq is looking a little bit different. So you are having the volatility spike, but for now, it's not moving higher as the US 500. It's stuck between trade and trend, and again it could be related to yields. So yes, this one may need more time. I'm gonna see what's happening with the range on MFR in the coming days, but for now, yeah, you can actually see and the X, you can see it bullish, it's not breaking down. So this one may need some more work. Finally, Europe is cracking. So CAC broke trend hard. This is good. Same on the MFR. You can see this is the CAC finally back to neutral. DAX back to neutral. This is looking good. You have a huge spike in volatility. So this is also what you want to see when you have a crash. So same on DAX. Trend broke, volatility spiking. You want to see an acceleration of it. Especially another good thing is the matrix which I'm looking at. It's basically this thing here is measuring momentum, so it will give you an idea of how low the price can keep going down, and we've barely started the move. It's the same for CAC. You can see here there are much more room to go down. So I like the European charts here. Somebody asked about IBEX 2 weeks ago. So now you got your reply, right? I explained the same setup. Trade was getting smashed, and at some point volatility just can't go down. So I mentioned that it was a good place to short Spain. That's what happened. You get volatility spike. Now we want this thing to continue. Dollar. So dollar, I'm a bit less enthusiastic about the dollar for a reason. It's because trade has not is below trend, and this is not very good. When you have an asset that is very bullish, you want trade to be above trend, and for now we don't have this setup. So I'm a little bit concerned about this one. So I've mentioned also that 2 weeks ago, I'm waiting for matrix cycle to complete. So it started to move on the 1st of March. And now we want to wait for it to finish and to start coming back up. At least I would get more confidence when I'm adding to long dollar, short Euro USD, which are my 2 positions in FX. But yeah, this thing is concerning to me. So I'm watching it. So Euro USD. So yeah, same setup. We have volatility spiking. I mentioned also 2 weeks ago that I was expecting some relief just above trade and see reject here. I mentioned this for Euro USD. I mentioned this for gold, platinum, and silver. So gold, it went above, and now I'm waiting for it to reverse. So that would be my my base case. We saw this for platinum. So platinum went right above and then smashed. So I think volatility has more room up for precious metals. So I would expect this thing to happen. Silver tried to go, also slammed down. I would expect volatility to rise back up. The 2-year and 10-year. So the 2-year still have room on matrix, so momentum to go down. It actually broke trend here, which is surprising to me. But considering my view is that we are going higher on the 2-year, we are going higher on the 10-year, I would expect this volatility to end and the US 2-year to reclaim trend. So I started a long short-term bonds, so in Europe and in US. So it was 0-1 year and 1-3 year product, the 8th of March. So I posted about it on Twitter, and this was very timely, I would say. But yeah, my base case is still that we are going higher, and I think we're going to go higher in the next maybe 2 to 3 months. But yeah, for now, it's not the time to unload. I would guess we can either go a bit lower or just do some sideways action. The volatility spike was just insane. But ultimately, I think we're going to reclaim trend and it's going to keep rising higher. So US 10-year, same kind of setup. You can see the move happened on the matrix, volatility spike. And now I would guess we need some more time here, like we had over there, you know, before we start the next leg higher. Ted mentioned US oil, so I was trading the range 80 to 74. We broke that range with the volatility spike, so I closed the remaining long I had in US oil, and I'm waiting to see what's going to happen. As I've mentioned before, I'm still waiting for an inflationary puke to happen, and in that case, energy is a good position to have. So for now, I cut it because we broke the range, but I'm certainly looking at it to re-enter before we get the inflationary puke. VIX, so yeah, like Rob mentioned, anytime we've tried to go above 30, it got smacked down. For now, volatility going higher is still a possibility. You can see here the trade of VIX has not reached yet the place where you would actually have to cut all your shorts because a new BMR could start. So we have a lot of time before reaching this point. So I've called yesterday a move for today and tomorrow, a move up on VIX. The reason I did that is because on hourly, the volatility trade of VIX will usually not go more than this value 12.8, and before we get actually a rise in VIX. So that's basically what we had, and I was set up for this. It was basically an easy call. So you have volatility crashing down. So that's why you get the VIX move up. And when we get this kind of setup, usually it lasts between 2 to 3 days. So my guess is tomorrow we should get another move up on VIX, and or Friday would be the same kind of setup. So my guess would be that we're gonna break 30 either tomorrow or Friday. I think vol sellers are about to blow up, and it's gonna be tomorrow or the day after tomorrow. So of course, if we get that and we get a good setup to add on SPX and Nasdaq, that would be awesome. So I'm gonna watch this. I'm gonna watch the monkey is trying to bid tech and maybe SPX, maybe Europe to add back, to add more on the short, expecting VIX actually to break above 30. I really believe it's possible that we get a VIX move much larger than what we've had last year. Basically, last year we got moved to 34, 35, but it was never going higher. I think this time, considering what the kind of price action we are seeing at 30, so vol sellers coming in repeatedly and heavily at 30 to short it, I think if we break it, it's going to be a very violent move. So yeah, that's my take. Yeah, the easy move was from 40.80 to basically this week. Now it's a little more complicated. So yeah, I'm very open-minded about what we're gonna see. But yeah, I've laid out my my thinking. Okay, so
Yeah. Also, Raph, like on VIX, if you look at I look at like IB ranks, been watching those and tracking them day over day, and those are still pretty cheap. I mean, relatively. So they're at, if you look at SPY and Qs is at 40%. They've actually been like selling their puts and Qs. SPYs are at 47%, and then IWM's at 50%. So it's interesting, actually. This might have been another reason that Qs were better supported coming into this. Was earlier, actually back on February 2nd, there was a lot more vol in QQQ. Those back when IWM got to the cheapest vols for the entire bear market on February 2nd, 2023, they got to a 0% IB rank. Qs was still at like 30, mid 30s, I want to say. So vol was a lot cheap, was a lot more expensive in Qs, and now this is actually starting to flip. Russell is getting a lot more expensive, and so yeah, so I think you have the catalyst with the Fed hawkishness to get vols to spike in Qs. I think you need that in order to get the real VIX spike. You need NASDAQ to fail. So yeah, I don't know if that happens soon, or they're trying to keep it afloat. I'm not quite sure what it's going to take, you know, for it to happen in the next 2 days, unless maybe you get Nick Timrose to send an article out. Let's see if that comes out tomorrow.
Maybe
he was probably shorting NASDAQ all day today, Ted, and then he's getting ready to send his article at 8 o'clock or 9 o'clock.
yeah, that's
It's got an implied vol discount right now too. The Qs do. So it's people are just using it as their hedge for whatever. I don't know.
Yeah.
It makes no sense to me.
Yeah,
And I'm just like, okay,
today.
you gotta go green on me. I'm gonna sell more. I'm gonna buy more PSQ. I've been using PSQ rather than short, but it's just easier. Yeah, I agree.
Yeah, it's something is brewing.
I think we're looking at a big vol event here, guys. I don't think this is close to being over.
Yeah. It's
I'd love to see it, tags. I got these SPY 370s that I was a little ambitious with. That expire at the end of March, and I'm wondering whether I should cut them now or should I see if they go in the money. So
be greedy, my friend. Be greedy.
It's interesting. I've never I didn't trade much options at all last year, like in terms of trying to buy puts at the top and riding them till the VIX spike like now. And so back February, and I started a little earlier, too early, unfortunately, on some of them, but I've been riding them since February 2nd, just waiting for this. And I went out to March 31st, and then I had the end of June as well. And so I'm not quite, I think I just dump them all once we think VIX tops. But right now it's kind of like you could book the gains, or there's a big payday coming if you wait a little longer for the final, VIX push. So that's what I'm kind of battling with a little.
If you use the script buy sell daily for the signal,
Yeah.
I think we are pretty far from a sell in VIX. So
I'm waiting for that. I'm waiting for that one to trigger wrap. So they're not failing me.
I mean, there are a lot of clues that say this time is different, and the fact that Rob mentioned this also, it's just a confirmation of what you can observe. I mean, how many months we've lasted without a VIX move, and now they're gonna say, oh yeah, it's not gonna go above 30. while you have a so-called banking crisis and etc. I mean, they really think we are stupid. I mean, of course, we're gonna have a crazy vol event.
We haven't seen VIX this high where we are now since November 10th.
Yeah, so it's a very long time, very long time.
Yeah, that was one thing we were talking about when VIX was just pushing into 18s, 17s throughout all of December or January into February. It was like, how long have we gone before? This is longer than anything in the bull market. Remember, like 2021, we had a VIX spike every month, and now it's like we were waiting so long for this, and so
Yeah.
I love that Mike Wilson. Mike Wilson, you said the bear capitulation date was February 2nd. It was March 6th when Mike Wilson from Morgan Stanley capitulated at VIX 18, and the thing turned on a dime. And then this thing was out calling for short every rip.
Yeah.
A 1 week bull call.
The bulls are nowhere to be seen now. They were like everywhere in February.
I was one of them right until until mid-February.
Yeah, but you switch at the right time. So I mean,
gotta be.
But yes, some guys, they are still mocking bears. Like I don't get it.
I just don't see where's the bull case here. I mean, it's either inflation or deflation. I can't see anything else.
That's a big question.
The bull case is how they completely pivot next week, and the banking thing isn't a big issue, and then you get a month of stocks up, yields down, another bond BMR.
I mean, basically with this new credit thing, they basically implemented a QE program, not dissimilar to what was done with the British pound back in Great Britain back in September, right? So we've already got this sort of de facto easing, and with the 2-year backing off 130 basis points from 5.05. I mean, that's just insane. That does not happen very often, and it is a precursor to something bigger, my view.
Mm-hmm. Yeah, and it doesn't happen when unemployment's still at like an all-time low almost.
Well, that's that's peak of the cycle, right? I mean, it's a lagging indicator, and employment at 3.6%. Everybody's making money. How does it get better?
Mm-hmm.
Mm-hmm. Yeah, one worry I have for the big puke, and for the big puke, the one worry I have is the long-term correlations, because they started to move. I think it was the 5th of February. They started to go. The one I'm looking at started to move 5th of January, but it's not yet at the level where you're gonna get the big explosion with bonds and equities trading down together, because this is what I'm waiting for. And for the deflation trade, which is supposed to come after, the unemployment is also something I'm watching, and it's not there yet. So there's only 2 things I'm a little worried about. Will we go to like VIX 40, then we just enter another BMR for another 1-2 months? Or we get the big puke now? This I really don't know. So yeah, I guess we shall see in 2 weeks. I would guess that we will get our VIX event by then.
One thing I just wanted to add, what I've been waiting for if we do get some sort of volatility event is many of the past events. What you have happen is you have the initial blowout of an implied realized spread, which is kind of what we've had now. It hasn't been that extreme, but we got to say 11 points. And then you have a snapback where both implied volatility decreases and realized volatility increases to the point where you've basically closed the spread. But it's so volatile at that point that they either stay par while you're getting that vol event, or implied volatility can't even keep up with realized volatility.
Mm-hmm.
You saw that happen basically in the 2008 crash and 2020 crash as well. So today's failure to recapture and move above the 30 level kind of makes me think there's a big jump in equities on the way, which would cause that spread to compress. But that's just a big guess. I don't know. And Raph, you said you're still looking within the next 2 days for something big to happen.
Yes. Basically, if we don't get a VIX spike tomorrow, the day after tomorrow, then maybe we get the dip in VIX, and then we get the when we usually get that. Basically, VIX we test trade and then just flash higher. So
right. I pulled up a chart of 2008 because it is really kind of reminiscent of 2008. And one of the things that I saw that was really interesting was on September 18th, 2008, I believe. This was, I guess, a couple days after the collapse of Lehman Brothers, but the S&P 500 had a huge spike up above its upper Bollinger Band and then closed below, but still up on the day. It was a massive spike, and that kind of kicked off the whole decline after that.
Yeah, we do need a spike up in realized vol in order for this to manifest, I think, because it's just hanging. I was looking at SPY, and the realized vol is like 17, 18 over the last week. It's pretty low. And so, you don't have some of the vol control funds aren't really having to make changes to their funding, these big insurance companies. But as soon as that realized vol goes up and we've got that's captured in the price data, I think we get some of that selling to take place and take the index down. We'll see.
Right. And like Bryan was saying, that probably doesn't happen without participation from the NASDAQ.
Yeah. That's your safety play. Long queues, short SPYs. There you go.
It's driving me nuts.
You and everybody else.
Yeah, this bear market is really something. So yeah, I think we can wrap it up.
How did our bets go last week or 2 weeks?
So the bet was a bounce above 40.80, and I said yes.
We got to give it to you. That was like 2 points away, right?
Yeah, I almost got there.
Spot on. That was good.
Yeah, you were right.
Yeah, I was lucky. I'm on a roll these past 2 weeks. With the VIX spike 2 times. I'm like, yeah. But I'm in a good mood. I'm making a lot of money, so I'm in a very good mood, and I take time to check. So it's much better than getting your face ripped by a huge BMR.
Yeah,
definitely.
So yeah, we can do another bet, but we are missing everybody. But yeah, sure, let's do another one. Okay, so do we get a VIX above 40 by the next 2 weeks?
No.
So no.
I'm going with yes.
I'm going with yes too.
Normally I'm super bearish, so hopefully this works.
I'll go with yes, Raph. You've got so many data points within the next 2 weeks that capture like 2020, 2008.
Yeah.
If it was boring 2 weeks ago, it's not boring right now.
Yes.
Did you say yes, Rob?
Yeah, I said yes.
640? The next two. All right.
Yeah, I think if we don't go above VIX 40 in the next 2 weeks, I think then we have a BMR. That's as simple as this. We get then we will hear everything about SPIX going back to all-time high, the Fed going to pivot. So yeah. Okay, guys. So let's wrap it up. We were shorter than last time, which is good because I know people complain we are taking too much time. So 1 hour and 15 minutes. It's pretty good. So if we can keep this up next in 2 weeks, that would be great. So Robbie, we hope you will be joining with the return of my twin brother, Vi. So so yeah, and also yeah, we didn't have macro today because Christopher was skiing. So lucky.
Yeah.
We've no snow in Europe currently because it's too hot.
I hope you get your garbage people squared away in Paris. I'm heading over in June.
Yeah.
What a cluster.
You can dream about it because it's not gonna happen. The government is basically tried to push the mayor of the socialist mayor of Paris to do it, and she said no. So yeah,
That's crazy.
yeah, you're gonna be. So, I don't. You've been to Paris before, so maybe you know how it is. But yeah,
Yeah. Last time was 2013 for the tour, but
okay.
yeah,
it became less romantic. I can tell you that.
yeah, I'm sure. We're only there for 4 days, and then we're heading down to the south coast and then over to Italy. So we'll see.
Yeah, okay, yeah, Italy is much better. Okay, guys. So let's pray for
All right,
this
thank you.
spike, and yeah, we talk to each other again. We see each other again in 2 weeks. Okay, take care. And
Thank you.
we
Thank you.
didn't-
Bye.
oh, sorry. We have one question for because they only manifested themselves right now. Sorry about it. Can you give some comments about banking sector? How do you see it goes? I guess we have no idea, right?
I have no idea.
Yeah. How do you see the
Where
outlook?
there's smoke, there's fire.
Yeah,
I think if anything, it causes a bear market rally at this point. If the only if we don't get to VIX 40, it's because of the banks.
exactly.
Yeah.
How do you see the outlook for Euro 10-year bond? So I will use the French 10-year and the German 10-year, which I'm watching as proxies to answer this. My macro view is the same for Europe as for US. They're gonna keep rising. Yields are gonna keep going higher because if they don't do this, inflation is gonna come back. Okay, people are thinking this inflation thing is 1 month or 6 months stuff. It's not. Deflation lasted several decades. I think the inflation issue is gonna last the same amount of time, probably a decade, maybe more. So people should think about that way. We are going higher, and there may be some point where you can buy bonds. I think it's going to be much higher, and then it's going to stay very high. So that's my view on the euro bond stuff. If euro don't explode during this crisis, okay. Maybe you have different view.
Nope.
Okay, we good.
I don't know about a decade. I don't know what the heck happens over a decade. All I know is right now, gonna be long bonds.
Yeah, and you can see. There will be a time, maybe this year, maybe I would guess end of summer or at least in second half of the year, maybe more interesting. But for now, it's very hard to bet. Okay, guys, so sorry I didn't see the questions before, and yeah, see you in 2 weeks.
Bye.
Bye, guys.
Take care.
Okay.
Very good. That's a good one.